Welcome to Break Away from the Rat Race, a podcast series to awaken your entrepreneurial spirit and help you achieve financial freedom. On our show, you'll learn about investments and how to create passive income. Let's get started with your host, Eric Martel.
Well, welcome back to another episode of Break Away from the Rat Race. And today the topic is about depreciation. I know this is not a very exciting topic, not to say the least, maybe I would even say a boring topic for some. But once you understand that there is something that you can do that's pretty cool about depreciation and you can save a significant amount of tax dollars, I think that may get some people excited. So, as you know, this is filing season right now, and it's kind of, in filing season is not necessarily always the right time to think about it. So think about taxes year round and plan year round. But as you are going through your preliminary numbers right now for the tax season, if you have a lot of passive income and you're looking for additional deduction, this particular accelerated depreciation method may help you save a significant amount of taxes for this year. So this is something that you need to be considered. If I ask many investors right now and say, hey, if you buy a building, an apartment building, what's the depreciation? How do I depreciate that? Most people would say that you depreciate that over 27 and a half years, because this is kind of like the default straight line method that the CPA are using, and it's easy for everybody to understand, and you don't have to do anything special to get that kind of depreciation. But there is a lot more to that. And so before I get started, I just want people to understand that I am not a CPA. I'm an experienced real estate investor. I've done that for many years, and I run a multi-million-dollar turnkey rental company. So I'm speaking as someone who has a lot of experience around tax issues and real estate investment. And but I'm not a CPA. So and every situation is different. So my goal here is to kind of give you additional ideas and open maybe your mind to some of you about other methods of depreciation and what the impact might be on your taxes. But every situation is different, so you should really speak to your CPA to make sure that how these depreciation would apply, and if they would apply at all in your particular situation. I'm only going to talk to this additional depreciation method today. There are other depreciation methods, and you can look at that in there's a publication by the IRS about depreciation, and you can look at all the different methods that are allowed for the different types of assets that you want to depreciate. Just to get started, I want to show an example. So let's say you've bought this 20 unit apartment building for $1 million. $1 million, right? So typically they would say, your CPA would normally say, hey, you know what, your default depreciation is going to be, we have to take out the land value, which is, let's say in this example, 20%. So the value of the structure is what you would depreciate, and you would depreciate $800,000, for example, over 27 and a half years. So for the next 27 and a half years, you would be able to deduct $29,000 off your income. And we're going to talk about the different types of incomes later on and the different class. But that's basically the default depreciation. And if you look at this, when I'm buying the building, I'm not just buying a building, I'm buying all kinds of stuff that comes with a building. So I could break it down into the different components. When I buy this 20 unit apartment building, I'm also buying 20 air conditioning units. I'm buying 20 fridges, 20 stoves. I'm also buying, in terms of cabinets for the bathroom, for the kitchen, all of that. Also the fence outside, the pavement, the parking lot, any kind of stairs, landing, that's also in the exterior structure. This is also, so I'm buying a whole bunch of different components. And then, but all these components, typically, if I was to buy an air conditioning unit, it would not depreciate over 27 and a half years if I was to buy just an air conditioning unit. But the IRS actually gives you a depreciation schedule for all the different types of asset that you could buy. So appliances, carpeting, furniture, 5 years. Fences and roads for the pavements and for the fence for the whole building over 15 years. So now if we were to break down our the cost of our structure into the different components, we could get something like this, right? So if we were to break down, so the land value is still going to be $200,000. Then I could break down the appliances, the flooring, the furniture that I provide in there, about $80,000 for the whole structure. Fences and pavement, $40,000. And then the rest of the structure, would be around $680,000, right? So I could break that down into these different components. So before I go into this, so that breakdown, even though I said you could break it down, it has to be done by a professional. So you need to order a cost segregation study, and it needs to be completed by a certified member of the American Society of Cost Segregation Professional. So if you're looking for one, just text me and I can give you some referrals for these professionals. The professional will do a cost segregation study, and they would break it down into the different components, and they would really get you to understand what that breakdown does for you. And then basically on the right hand side we have the useful life. So this is the period of time over which you will depreciate that particular asset. So for appliances, flooring, furniture, you depreciate that over 5 years. So that means that every year I would be able to depreciate $16,000 for that, for these assets. For the fences and pavement, it's over 15 years, so about $3,000 on that, $2,666. The rest of the structure, over 27 and a half years as we had before, and that would be over $24,000. So basically, I would be able to depreciate $43,000 instead of what I had before, which was the $29,000 annually. So at least for the first 5 years, right? So this is a significant increase in the amount that you can deduct. So if you're looking for a few dollars here, so this could be a good way to do that. But it gets even better than this, because with the tax reform of 2018, we allow bonus depreciation on every items that have 20 years or less in terms of the tax recovery period or their useful life. So that means that these items like appliances, the flooring and all of that, the fences and pavement, instead of depreciating them over 5 years or 15 years, I can take 100% bonus depreciation in that year, in the year that I bought that property. So right now, then my first year depreciation would be $144,000 instead of the $29,000 that I had if I had done the whole building over 27 and a half years. So this is a significant advantage if you're looking for a significant deduction for the tax year. So this would be a good one, right? So the standard depreciation that you see here is basically the first year and the following years is the same, $29,000. But if you do the component depreciation, which is where we break down that building into its subcomponents and then depreciate and do the bonus depreciation, then the first year you would be able to depreciate $144,000, which is a significant change. And then the following years, it would be $24,000. So it'd be a little bit less for the following years. But if you're looking for a depreciation this year, this would be an excellent way to do that. You don't have to do the depreciation the same year that so if you bought a building in 2019, you can wait, you can run your numbers right now and say, okay, well, I need the depreciation. I need that $144,000 depreciation. So I'm going to call a cost segregation study professional, and they're going to do the cost segregation study, and then I will file my taxes, in May or June or whatever, to take advantage of that depreciation. So that's what's going on here. So how it affects your taxes. So now we have that depreciation number. So the next important thing that we need to consider is that now we have that depreciation number, we want to look at how does that affect your taxes. The IRS wants basically the depreciation to offset passive income. So that's where they want it to be seen. But the idea is that can that passive income, if I have a negative passive income loss, how can that passive income loss actually affect and offset my active income? So this is how you would reduce your income tax at that point. You could reduce it on the passive income side if you have a lot of passive income. So that deduction would actually reduce that passive income, and you would not increase your overall income as much. But another advantage too is to basically have a passive income loss that would also offset your active income. And there are 4 different classifications for this. I'm going to talk about 2 here. Again, speak with your CPA and tax professional to really understand how you can be classified for one or the other. There are some criteria for that, and you need to be able to defend one or the other. On the real estate investor side, so the ordinary income is basically any kind of income where the taxpayer is materially participating in that business or that work to make their money, to make that income. So that includes wages, tips, commission. If you own a store and you make money from that store, then that would be part of that. And then everything else, passive income, would be kind of like the rental income. If you have like apartment building, as we're discussing, or capital gains, then that would be considered passive income. So for that particular individual, so that deduction that we talked about, $144,000 in our example, would offset that passive income. Right, so if you have more than that, then that's fine. Then it would really reduce that. It would reduce your overall income, and you would pay less taxes. If you don't have as much in passive income, then you won't be able to. You're going to be capped basically at the amount of passive income that you have. You won't be able to transfer a passive income loss to and then offset your active income. So that's going to be your cap here, is the amount of passive income that you have there. The other one is the real estate professional. So basically, if you make any wages, tips, and stuff like that, typically, they would also be considered as part of the active income. Then you have the rental income, though, would be part of your ordinary income at that point. And then capital gains, some capital gains would also be considered. If you're a dealer, it would be considered your ordinary income. And the passive income would be some other kind of capital gains, and if you get dividends and stuff like that from other companies, that would also that would classify then as passive income. So for that, for the real estate professional, then you can basically, again, you're offset against that depreciation against your passive income. But the advantage of the real estate professional is that your passive income loss can also offset your ordinary income and your active income. So 100% of your passive income loss can be used to offset your active income. So this is a critical component, but you need to qualify to be a real estate professional. So again, speak with your CPA to make sure that you qualify and that you can take advantage of that deduction. So that's it for that. A couple of questions that I know some of you are going to answer. Can I still apply component depreciation if I bought the building in 2018, not only this in 2019, but even a previous year? So it is possible without having to amend your that 2018 or 2019 income tax. So you need to speak with that cost segregation company, and then they would help you file out. There's just another different set of forms that need to be filed. Your CPA may also help you with that. If you need any referrals, feel free to ask me. Should I always go for the component depreciation? And again, this is not, you have to look at that passive income. Does it make sense for you to go and try to get a big depreciation on a building if you don't really need it? Because it does cost some money to do the cost segregation study. It takes a little bit more effort on your CPA side. So our recommendation, and when I speak with my CPA, is to basically, let's just wait to see at the end of the year as we're preparing the filing for this year. Let's see how much passive income we have, how much active income we have, and then determine, do we need to go for a component depreciation, or can we just leave it as is for now and just do a regular depreciation or not depreciate at all? So these are kind of the decision you have to make. You can make that decision after you've seen your preliminary numbers and you see what you have to deal with, and then you make a decision. Then you call your cost segregation consultant. They would run the analysis, and you'll be able to file. You may have to file a little bit later, but you have to file an extension, and then you'll be able to file then your income with that. With this new depreciation number. And I cannot emphasize enough, so every situation is different. As you can see, I'm just scratching the surface of, there's all kinds of rules, all kinds of very detailed piece of information that your CPA is aware of. My goal here in this podcast is to make you aware that there is something called a different way of depreciating these assets that could be beneficial and could save you a lot in tax dollars. But work with your CPA to understand kind of like if it makes sense and if it is something that you could take advantage of. And with that said, I want to wish you a great new year, and we'll see you in the next podcast. Thank you.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.